Welcome to the Beginner Investor Podcast. I'm your host, Luke Burke, and today I want to cover the topic of short selling. So let me give you the technical definition of what short selling is. Short selling is a trading strategy in which a trader aims to profit from a decline in a security's price by borrowing shares and selling them, hoping the stock price will then fall, enabling them to buy the shares back for less money. So what does that mean? So basically, the person who wants to sell the stock and buy it back at a lower price, they believe that the stock is actually going to go down. They're speculating that the stock is going to go down. So let me give you an example. Let's say company A just recently has some news. Their stock is currently set at $150. And let's say company A has some negative news. This investor notices that the news is coming down and the stock hasn't been impacted yet. So what this investor will do is that investor will say, you know what, I want to make some money on the downside of this stock. So let me go and borrow this share that cost $150 and let me go and sell this share for $150. So I'm selling it at that current value. Now what will happen is I sell it for $150, so I pocket the $150. Is that clear? So once that stock price begins to fall, the news happens and the stock begins to fall. Once that stock begins to fall, I take my $150 and I buy that stock back. Let's say it falls to $120. Now we're only talking about one share. Usually you're not going to be doing this with one share. If you're a short seller, you're going to be shorting more than just one share. Okay, so I'm only using one share as an example. So this stock goes down to $120. Well, I just pocketed $150, but I still owe this other person their share. And if this other person or entity or broker says, hey, I want a margin call, and that stock is going down, not saying that's going to happen that way, but the stock is going down, then you go and buy that stock for $120, pocketing, because you only paid $120, you sold it for $150 and you only pay $120 to get it back. Now you pocket the $30 and then you return the share back to the broker or the entity. And that's what short selling is. A few years ago, what happened was what's called a short squeeze. And the short squeeze caused some company, one particular company, I believe, to go out of business. So what happens in a short squeeze, the way a short seller loses money. So let's go back to our example. Remember, we sold the shares or share for $150 and we want to buy it back for $120 so we can profit the $30. Well, the problem with short selling, the risk in short selling, is that there is no limit to how much you can actually lose in a short selling case, because you lose when the stock goes up, and theoretically there is no number that a stock will have to stop going up. So for example, if you had sold that share for $150 and you still owe the person that you borrowed the share, you have to give that back to them. So if that stock goes from $150 to $250 and it goes up, then you now have to buy it for $250 just to return it. So instead of making the money when it goes down, you're going to lose the money when it goes up. So it could go up to infinity. It could go up to $550, and therefore you're losing $400. So you have to pay $550, even though you got $150. So now you still have to pay that difference, the $400 difference, just to pay that person back for their shares. And they're probably going to say, hey, great for me because I get to profit on this move. If they want to, if they're not long-term, if they're long-term holders and they want to just make some money, or if they're short-term holders, it doesn't really matter. So a short squeeze will happen because they want to run the price up. And as long as you're running the price up, the short seller is actually losing money. So the short seller has to cover. They have to cover, and they have to go back and get those shares back so that they can return them. What happened at GameStop started around $30 or something like that. So the short sellers were short. They were shorting the stock. And let's say they were shorting it, expecting it to go down to $15. They short the stock, and then the stock just went up to $400. So they have to recover. They have to go and cover those shares so they can return them. And the more it goes up, the more they're losing. And that's kind of what happened with the GameStop saga a few years ago. There were a lot of short sellers. And when people are trying to buy and raise that price up, then that's what they call a squeeze, because they're trying to squeeze those short sellers out. Okay, so that's what short selling is. Hopefully my description made some sense to you. I hope that you come back and watch more. And I just want to say thanks for watching.